Hey everyone, welcome to another podcast. We've concluded a pretty big week. We had CPI and FOMC. Everything played out pretty much picture perfect, exactly like we've been calling it. The Fed did not raise rates. CPI came in below expectations. Core CPI came in at expectations. Just like we've been saying, there's really no need for expecting inflation to randomly rip back up like a lot of people are saying. 5-year break evens have been telling the story this whole time. We've been looking at that. It's going to be front running CPI just like it did throughout all of 2022. It front ran CPI, it front ran the peak in CPI as well. And it would not be hovering at around that 2% mark right now if inflation was going to continue to be an issue. And so we saw that playing out. But now the question is, what does this mean for equities and bonds? So this CPI print coming in line, obviously not going down nearly as quickly as we went from 9% to 5%, which we've also highlighted. It's going to be a lot harder to go from where we are today back to 2%. It's going to take more time. But what does this mean for stocks and bonds, and especially with the Fed pausing?
Right. So stocks, obviously, without a doubt, broad-based, have done well. There's a small basket of stocks that have done phenomenal this year, and this really is around the idea of a soft landing, right? Or at least it's on the premise that we may achieve this soft landing. Now, we've been talking about this for a long time. The soft landing is impossible. Okay, we've been saying that the impossible soft landing will continue until all faith in the hard landing is lost. Now, what we've always meant by that, and what I still mean by that is, as you price out a recession and you take recession risk off the table, the generals, the leaders in the market, become automatically less risky. You can throw your PE multiple nonsense, all this revenue growth slowing. You could throw everything you want out the window. Okay, it's all nonsense. If there is no recession, the top stocks, the FANG name leaders tend to do pretty well. Reason is because it's very hard for those companies to not grow. They're so big, right? Now their growth can slow to a degree, but they're almost bulletproof to some degree. Like take Amazon, right? Amazon's growth could slow, but is Amazon not going to be Amazon? No. Same thing with Netflix. Netflix's growth could slow, but Netflix still has a huge market share on streaming. So these are the companies that remain resilient, and they're the ones that are doing phenomenal. Obviously, the AI boom has gotten a bunch of other stocks moving as well. But Nvidia, you could take another example, right? Like even though Nvidia's growth has slowed, um, itself, it's such a behemoth of a company that if there is no recession, what is going to take that company down, right? Because
Right.
it's a behemoth. It's basically you can argue it's a monopoly of a company, right? These monopolistic companies, it's very hard to take down. And the
Well, I,
reason
I
that
think
is
something that even contributes to that is everybody, it's common sense. These companies borrow a lot, and so higher rates hurt them. But we have a lot more, we have a lot better of an idea of where rates are going from here on out, the trajectory of rates. Whereas before, when the stock market was pricing in worst case scenario, we didn't know how high rates are going to have to go. And that's why these companies were getting hit so hard. So
true. Yeah,
it's not really
that's
high
right.
rates that hurt these companies that borrow a lot. It's more so the uncertainty of future rate projections.
Right. And borrowing costs involved and whatnot. Yeah, that's 100% right. Now, obviously, you also have to look at the comps, right? So coming out of COVID, the comps were huge, right? You went from pretty much a standstill economy to a rather fully functioning economy very quickly. And what ended up happening was it created these huge comps of like obscene year over year growth after year over year slowdown. Looks great on paper, but really, in terms of where these companies have gone, not so much, right? Compared to where they are today and from the peak, what I mean is once those companies had that initial liftoff after the closure, well, a year after that liftoff, your comps, You can't beat that growth. That type of growth was insane, right? We went from, like I said, 0 to 100 miles an hour. You cannot repeat that growth. So everything had a negative comp basis going into 2022, which is what dragged a lot of these companies down. On top of that, like you just said, Artie, as rates were going up, the terminal was really unknown. The duration of the terminal was unknown, and it wasn't. No one really knew if inflation was going to stop under 10%. We didn't know if we were going to be in the double digit inflation territory or not, and obviously we're not there
Right
now. But it's a lot easier to say that now than it was a year ago, right?
Yeah, and so now that we're getting all this confirmation with CPI and with the final, we're nearing the end stages, or we are at the end stages of the rate hike cycle. What does this mean for stocks? Like, where are they going to go? Is this soft landing idea going to continue and actually come to fruition? And like, when does the hard landing come?
So what's going to happen, and this is very common, right? As the Fed raises interest rates, and we're going to go over this in a little bit. What ends up happening is there's obviously a lag, right? A term of policy delay. So as they raise interest rates, the effects of those interest rates or that policy being implemented is dripped out into the market. We went from 0 to 500 basis points in 12 months, pretty much. I mean, 18 months, whatever. You get my point, right? 12, 18 months. So a little over a year. For that policy to really drip into the market, it's going to take some time. Now, I'm not saying 5% policy is detrimental to the economy, because in reality, it's the situation. It's not the rate, but it's the duration. We've said this many times. It's not the rate at which the Fed goes to; it's the duration of the rate at which it's held, and it's the stability of the economy, which it's the stability that the economy is in when those rates are held there. Meaning, it has nothing to do with what rate, when, or even when that rate's raised specifically, but it's when that rate is held and what's going on with the economy underneath it. If the economy is already poor and the rates are being jacked up and held, well, you're going to just deteriorate something that's already been breaking down. But if the economy is more durable, so on and so forth, it's going to be harder to kill it. So typically what ends up happening is as the Fed raises rates, this effect is bled into the market, and unemployment tends to pick up after the rate hiking cycle is over. Like, unemployment does not start reacting until there's a time lag for policy to be implemented into the economy. Okay, we've only had a year of this, so you have to assume that the hard landing will come. Now, the reason why the soft landing is such a phenomenal idea, or in terms of a narrative, right, a phenomenal narrative, is because you don't understand what's actually going on when you talk about a soft landing. What you're doing is you're putting goalposts up start to finish, and you're saying this is the soft landing, when in reality the economy isn't like that. Meaning, if you have the economy basically rebounding between these goalposts, but right after your last goalpost it falls apart, you would claim that this was a soft landing, but in reality you just pushed the can down the road and then you got the hard landing. That's really what happened here, or that's really what happened in history, and I think that's what's going to happen here again. Now, also, I've been very vocal about this. The hard landing is not a depression. You have to get this nonsense out of your head. Where this depression, this type of limit down, circuit breaker nonsense. This is like COVID traders and extreme deflationists that want the market for some reason to go to zero. This is not going to happen, right? Now, for the market to get bad, what I'm talking about is under 2022 lows. For that to happen, we need to outprice, as you said earlier, Artie, the situation that was at hand last year, where our growth projections, we were negative growth for a while in summer of 2022, and inflation projections, both of them have to congruently, or simultaneously, I mean, blow out in the same direction, to the same degree, to the same severity, to push us into a worse situation than we were last year. The odds of that happening are not very high, because we know where the Fed stands now. The market understands where the Fed is. We'll talk about where the Fed's going to go and whatnot in a few minutes. But I've been saying this, and I think what's going to happen here is we could have an NQ pullback. Sure. I mean, it's been bullish trend for months now. So NQ, if if it was up to me, NQ can go higher as long as it wants at this point. It's bullish trend, can just keep going. Obviously with Deuce, in terms of pulling back and bouncing around, and it can still resolve higher as long as the trend is bullish. But I do think that bonds make a move at some point here. Now, I'm not stamping the bond trade yet. Still bearish trend for me. So I'm not saying the bonds are going to go higher right now, but I think it's coming. Now, let's open up bonds. Bonds have been trading chop to pretty much sideways for the last almost 8 months now, right? And they haven't gone anywhere because there hasn't been a growth slowdown yet. As I just said, the higher rates will bleed into the economy, will slow growth. The way you slow inflation by slowing growth,
Right. Well,
slowing demand.
what are you referring to when you say slowing growth? Because our system has a growth measurement, as our members know, and it's been slowing. I mean, it's kind of hasn't really recovered ever since it dropped off back in, what was it, March?
Right.
When growth dropped
I'm
off
talking
again.
I'm talking about a materialistic. Like, okay, so our system is very sensitive, right? In what it monitors and what it picks up. I'm talking about like a real economic slowdown, like something that like like a real like. I'm talking about negative GDP prints and the whole nine.
Okay.
Like growth has been slowing, right? But like on what degree? Like I'm talking about negative GDP. I'm not talking about like rate of change or whatnot. Okay, I'm talking about like real negative GDP down.
Okay.
Okay, and that's really what bonds are looking for. Bonds are looking for unemployment up, type of thing. Now, as I said earlier, you need that negative growth to slow inflation. But I really want to rephrase that. You don't. It's not so much the negative growth that you need, but you need less dollars chasing goods, right? And that's what hiring interest rates or hiking rates does. It basically sucks money out of the ecosystem or the monetary system, and then as QT takes its effects, lowering bank reserves and whatnot, you're reducing the overall capital in the system, which is deflationary, which is what QT is, right? You can argue your TGA rebuilds and all that fucking bullshit all you want, but in reality, we're still doing QT, and QT will continue. That all that is going to do is put more brakes on the economy. You basically have an economy that's running right now. You got rates against it. You basically, it's imagine being on a treadmill and you got a weight vest put on you, and every couple of miles they're dropping another weight into that weight vest, and you still got to walk. That's what's going on with the economy right now. But the leaders of the economy, like I said earlier at the beginning of the podcast, they got quads like a motherfucker, and they could just keep walking. Okay, it doesn't matter. Like you could put how much weight, like for you to take down Apple 40-50% off the highs, you have to understand like you have to destroy a monopoly.
Yeah, like it takes a lot more to stop that momentum.
Right. Then like a small cap, biotech or a small cap, AI company that does like 70 million a quarter in revenue. Like,
And is that why we're seeing such a large discrepancy between the NASDAQ and the Russell right now too?
I think so because a lot of the Russell companies require, obviously there's more, the Russell index includes a lot more risky companies. I should say a lot more junk names, right? And those junk companies, they obviously have debt, and their debt, the cost to service their debt's much higher than an Apple, than an Amazon, than a Netflix, right? So they are going to be impacted more by these rates, and I think that's why we're seeing this discrepancy, because there's something about large cap growth when you understand it. Large cap growth is almost immune to everything. Now, it has its bubbles, it has its bursts, right? It has its things, but in terms of economic cycles, when you look at the Nasdaq, and let's go back to 2020, excuse me, 20, yeah, let's go back to 2020. That was that whole 40, 35%, 40% drawdown was COVID, right? Well, obviously, the economy shut down, everything was scared. Everyone was scared. But let's go back to 2000. Like, you look at the dot-com bubble, and you'll say, man, the Nasdaq's going to blow up again. Do you understand the durability of those companies in 2000? They were getting .com and going up. They were literally getting they were getting a domain name and going higher, right? Like, take a company like Apple, a major weight in the Nasdaq. Give me a company like Apple in 2000. There was none.
Right.
That
Yeah,
robust,
they've
that
gotten
don't that
so
dyna-
much bigger and so much more solid.
right. Like, give me a company, even Amazon, right? Amazon started out selling books. Think about where Amazon is today. It's just you you have to take, like, life is not linear and neither are markets. You have to take into perspective what has changed. To take down a company like Amazon and take down a company like, not to say they can't slide 20-30%, right? Amazon's still off the highs. Apple's at new all-time highs, right? Um, but to take these companies and outprice what everyone thought was going to happen last year, or basically push them lower to where they were last year, you have to have a situation that is worse than what the market thought was going to happen last year. And I don't see that happening. And even if it does, if the if the economy isn't if the economy isn't deep enough, or excuse me, if the recession the economy experiences isn't deep enough, you're not going to see a scenario like we saw last year by default.
Right. Well, so going back to your analogy of, a person walking with a weighted vest at, every time they hike rates, it's another weight added to the vest. And now we're at a fully loaded vest, kind of waiting for the economy to slow down, waiting for these rates to really take effect and bleed into the economy. What's something that people can look for? So there is the Russell and NASDAQ discrepancy. So you can kind of see, like, okay, small caps are getting hit already, but you have the big caps leading still. What can people
Right.
look for to start seeing that slowdown in momentum?
Well, I guess I should say that no matter what happens, it's going to be harder to kill a large cap company. So they can, with some chop, they can continue higher. And you might not realize you have a growth slowdown if you just looked at the Nasdaq. You might not realize it. If you look at between 2018 and 2019, the market experienced a growth slowdown. In reality, if you look at the situation in hand, you have to understand that you can't just look at one index and gauge basically an entire outcome. You have to look at the whole market, like you said. But look at small caps, right? Look at oil. Look at all these other things that are going on, and you'll realize that under the surface things aren't right. Now, if you're just a long Nasdaq investor, it might not be an issue. But if you're more invested in the market as a whole, and you own more, and you own a broader base of companies, or you're trying to get those leveraged targeted returns, which is what Aries does, you might have better returns in a different category, aka bonds, right? And that's why we're so focused on watching the bond trade, because between 2018 and 2019, Nasdaq performed rather well, but on a leveraged return volatility basis, bonds performed way better. So that's where we're focused right now. We're trying to figure out where we are we know where we are in the cycle. Obviously, we're risk off, but the question is when do bonds lift off from here? And that comes back down to the Fed to a degree, right? Because as the Fed holds rates for longer, they are going to delay this move in bonds. Now, let's move into what's expected from the Fed, at least in the next couple of weeks. Excuse me, the next couple of meetings. So right now, there's a 74% chance the Fed hikes rates at the July meeting. We think this has a good shot at fading. 41.9% chance rates are held or end up at this level by the December meeting 2023. Now, I think that this probability is going to grow because I don't see this rate hike materializing in the next meeting just yet. So what I mean by that is I don't think we're getting okay. Let me explain that. So Powell basically came out and said a few things during the FOMC meeting, the press release, that has me thinking that this is more of a hawkish setup, more than hawkish. I should say more hawkish talk than hawkish action. And what I mean by that is, he said, number one, inflation expectations remain well anchored. We know that. We've been reporting that. We've been looking at that. He said that. No, he also said there's a couple of years out for rate cuts, meaning that's, again, extremely hawkish. He said that the projections are not a plan or decision. Okay, that's not so hawkish. I mean, he said core is not in their favorable territory. Now, what he basically meant by all of this is that he basically is telling you that he's pointing to all these hawkish reasons, right? So what he's doing is he's lining up all these hawkish reasons to point to. If core was such a problem, they wouldn't have paused. It's not a problem, but he's going to point to it because the dot plot implies that there's more rate hikes coming, at least 1 to 2, right?
Right. He has to have a reason for why they need to hike more.
Right, exactly. So if he's going, like, the Fed is not going to just stop and say we're done. That's not what's going to happen.
Bonds would instantly just rip higher at that point.
Right, and that alone would have a loosening effects on the economy, right? I guess where I'm trying to go with this, and I'm not being so clear, so I'm going to clear it up. If the Fed was going to stop hiking, they wouldn't tell you directly that the hiking is over because they're still concerned that inflation could rebound. Everyone is, right? We all are just hoping it doesn't, but it could. So by him automatically giving markets the idea that inflation is over, rate hiking or more restrictiveness is over, what he's going to do is he's going to automatically loosen financial conditions. And he made some very specific remarks in his press conference where he was saying something along the lines of, I say a lot of this from memory, so I apologize if it's a little choppy, but he said something along the lines that nowadays in modern times, markets can react a lot quicker to new information because it's not like it was in the past where they had to find the information in the newspaper with everything hitting the newswire so quickly. And what he's referring to is he's almost lining up to say that if I come out here and tell you guys I'm going to stop hiking and we're going to stop rate hikes, you guys might start pricing in opposite policy very quickly, or you might just automatically loosen financial conditions to think things are going to get easier, which we obviously know rates are going to have to be held for some time, at least until inflation is resolved. Now, let's talk about inflation quickly here. Inflation's at 4%. And I remember a few months ago, or I think it was at least a few months ago, I was talking about the fact that the Fed is going to be in a position soon where they are going to question themselves if they've done too much. And as we go down, as we go down in inflation prints, meaning lower inflation prints, and the speed doesn't slow down, the Fed's going to be faced with a pretty big dilemma that did they over tighten? I don't think they did yet, but no one really knows based on the speed and aggression of those rate hikes. We don't really know yet. So we have to figure out where the economy lies with this tightness in terms of reaction, right? And is this level of inflation going to be very sticky on the way down? The expectations are for the June print due next month from the Cleveland Fed, we're in the low 3s right now. Low 3%. Which that's kind of scary, right?
Right. And something that we're going to be looking at is our growth projections from our system. So the market's always going to pick these things up faster than economic data. It's going to know if the Fed has over tightened by pricing in growth getting completely crushed. Whereas right now it's not getting crushed. Right. Growth is low, but we are keeping an eye out. Our system is keeping an eye out on these growth crushes that could happen. And those will start being priced in by the market before any economic data picks it up, before you see unemployment skyrocket or anything like that. That's obviously going to add to the market pricing in a crush in growth, but it's also going to start pricing it in beforehand.
Exactly. And I guess to go back to what you were saying earlier and to clarify, in terms of growth, the system is very complex and it uses multiple indicators to compile its results. So just because the system is negative growth doesn't mean you're going to see or you need to be focused on negative GDP prints, right? Meaning GDP can slow in a manner, it doesn't need to go negative. But just its slowing is risk off enough for the system to pick up and for bonds usually to make a move. So you have to be very understanding that this is not a linear thing. Just because this happens, this is going to happen. You have to understand that that's why we have checks and balances within the system, right? So just because we've been risk off, generally the system's been risk off for a while now. But if bonds are in bullish trend, something is not right. And that's why the checks and balances are so important. You don't just take a market, I should say, an economic data model and just say, oh, it's time to do this. It's going to work. No, well, if the market's not lining up with the economy, the stock market and the economy are not the same thing. This is why you need checks and balances. So the checks and balances basically make sure that you're aligned with when the market and the economy are in the same direction.
Well, so let's go into the calendar for next week, and we can wrap it up here. So we've got a very slow week next week in terms of market events. Monday, markets are closed. And Tuesday, we've got housing starts and permits. Thursday, jobless claims. Of course, we'll be looking at that. Friday, PMI composite flash. So a very light week coming up, which, it's good to have a light week after especially having such a jam-packed week this week with CPI and FOMC.
We'll wrap it up here. Yep. I thank you guys so much for listening. Tune back in next week for our next update.